A 60.57% win rate can still lose money if the average loss is more than 3 times the average win. This FTMO account proved it: 743 ZOS trades, and a final net loss of $885.33. That is the uncomfortable part of trading. A lot of people look at win rate first and feel safe. But win rate by itself tells you almost nothing about whether the economics of the strategy are actually working. Here, the gross profit was $747.70. Gross loss was $1,633.03. The average win was only $1.66, while the average loss was minus $5.57. So yes, the account was right more often than it was wrong. But the wrong trades were much larger than the right ones. That is how a system loses money while still looking active and even competent on the surface. The entire sample was ZOSed. One instrument, all the way through. That kind of concentration can be fine if you truly understand the market regime, but it also means every weakness in timing, spread, volatility, and execution gets amplified. The account also showed 99 same-direction overlapping entries. Maybe that was deliberate DCA. Maybe it was structured scaling. The data alone cannot prove intent. But it does show layered exposure, and layered exposure is where drawdowns become harder to control. The size breakdown is even more revealing. The smallest tier had 362 trades and won 80.11% of the time, yet still lost $121.62. Tier 2 had 368 trades and lost $436.23. The bigger size buckets were too sparse to offset the damage. That is the core lesson: more wins in smaller size do not rescue a strategy if the losses are structurally larger. Activity did not help either. On 4 high-activity days, defined as at least 47 trades, the account averaged minus $2.00 per trade. On normal days, it was still negative, but less bad at minus 58 cents per trade. The high-activity bucket accounted for 627 trades and minus $842.58 in losses. So frequency was not creating edge. It was creating friction. The re-entry behavior matters too. There were 255 rapid post-loss re-entries and 366 rapid post-win re-entries. The next trade was worse after losses, with expectancy at minus $1.48 after a loss versus minus 99 cents after a win. That does not prove emotional revenge trading. It does show that the sequence mattered, and that the system was vulnerable once the first trade in a cluster went wrong. Timing was not uniform. Positive expectancy showed up in hours 8, 9, 10, 12, 19, and 20. Hour 18 was especially poor at minus $18.00 expectancy across 23 trades, and hour 13 was also weak at minus $6.60. By weekday, Wednesday and Thursday were positive, while Monday was sharply negative at minus $768.32. That tells you the edge, if there was one, was conditional, not broad-based. The practical lesson is not regret. It is risk design. The operator said the bot was not programmed to prevent a max daily drawdown breach, and that DCA was abandoned because it could not actively control risk size relative to target profit. That is a sensible conclusion. On a challenge account, survival comes first. Profit comes after the loss boundary is respected. So the real question is not whether a method can win. It is whether it can survive the bad sequence that eventually arrives. If you do not design for that, a high win rate can still fail exactly where it matters most.